You want to be financially free and you want to do it as quickly as possible, but first you need more money. And there's really only three ways to get more money. You can either earn more, spend less, and invest the difference. Now, there's a realistic limit to how much money you can save, and nobody is ever going to become wealthy simply by clipping more coupons. And unless you're someone like Jeff Bezos or Bill Gates, there's also a realistic limit to how much money people can earn. The key, though, lies in that last option, investing. Investing is the key to building wealth. Now, there's a lot of different ways you can invest your money: stocks, bonds, crypto, notes, collectibles. But in this video, I'm going to show you my personal favorite thing to invest in. Now, when it comes to investments, generally speaking, the riskier the investment, the higher the potential rate of return. But what if I said that there was an asset class that is generally considered to be one of the absolute safest things you could invest in, that you could consistently outperform the stock market by a lot? And it's this insane rate of return that will allow people to achieve financial independence in a reasonable amount of time. Let's take a look at a few investment options at various interest rates. Let's assume a $20,000 initial investment, and we will let it grow for the next 40 years. At an annual rate of return of 0.5%, which is what most high-yield online bank accounts are offering, your 20 grand will have grown to, drum roll please, $24,415. In other words, it's crap. If instead we had got a 5% interest rate, that would boost our end balance up to $141,000. At a 10% interest rate, we would have $905,000. And for reference sake, the stock market historically averages somewhere between 8 to 10% rate of return over the long run. But what if we could easily get 20% or more? At a 20% rate of return, our initial 20 grand would turn into over $29 million. Now we're talking. So how are we going to get those astronomical rates of return? Real estate. Real estate has made more people wealthy than any other asset class in the world. The average net worth of a renter is only $6,300, while the net worth of your average home owner is over $250,000. Real estate, baby. So how is this insane rate of return possible? Well, it's partially due to the use of leverage. You see, when you buy a house, most people don't just plop down hundreds of thousands of dollars and pay cash for the house. Instead, they use a mortgage. And with a mortgage, you don't need to pay the full amount right away. You just need a down payment. If you're buying an investment property to rent out, you will probably need somewhere in the neighborhood of 10 to 20% of the cost of the house as a down payment. And if you're planning on living in the home yourself, you can usually go all the way down to 3.5% down payment with an FHA loan, or 0% with a USDA loan in a slightly more rural location. Now, if you combine the use of leverage with an appreciating asset, you can quickly amplify your gains. And here's what I mean by that. Nobel Prize-winning economist Robert Shiller researched the effects of housing prices, which is known as the Case-Shiller Index. And the overly simplified takeaway of this research is that homes don't really appreciate in value over the long run by very much. Instead, they tend to simply keep pace with inflation. And this makes logical sense because if homes appreciated less than inflation, then eventually homes would become super cheap and everyone could buy multiple houses. And if they appreciated faster than inflation, then eventually nobody could afford one. Now, what this means is that if inflation is, let's just say 3%, then on average, we should expect the price of our homes to rise by 3% as well. Yes, some geographic areas will have different rates of appreciation, but generally speaking, on average, if inflation is 3%, we should also expect roughly 3%. So on average, let's just take a $200,000 house that we bought, will be worth roughly 3% more next year, or $206,000. And at this point you say, big deal, you made $6,000 in profit or a 3% profit. That's a far cry from the 20% you were promising at the beginning of this video. And you're right, I did promise you 20%. But the key thing to remember is that you didn't pay $200,000 for this house. You only had to pay 20% down payment for this rental house. You only had to put up $40,000, so making $6,000 profit on a $40,000 investment is a 15% rate of return. By using leverage, we are able to amplify our rates of return. So we got a 15% rate of return just off of appreciation alone. That's not counting other things like tax benefits of owning real estate, equity pay down from eventually paying down the debt levels of our mortgage, and that's not counting any cash flow that we might be getting from renting this house out. If we can get 15% rate of return just off appreciation alone, we can easily get over 20% total once we combine those other three factors: debt pay down, cash flow, and tax savings. And this is assuming we actually buy the house at fair market value. What if we spent a little bit of time and effort to find a house that we could buy that was below market value? Additionally, many people think that in the coming years, our nation will experience higher than average inflation rates due to the insane spending our country has gone through getting through this pandemic. If inflation is higher than average, that actually helps us, since the value of our homes is indirectly tied to the overall rate of inflation. So if inflation is, 4 or 5% in the coming years, that means we'll be getting 20 or 25% rate of returns just from the home appreciating in value each year, assuming a 20% down payment. Not to mention, like I said, that cash flow, debt payment, and all that other stuff. When it comes to using leverage to buy inflation-adjusted assets like real estate, high inflation rates is actually one of the better things that we could ever hope for. Not only does it cause the value of our asset to go up, but it causes the value of our debt, the value of how much money we owe due to our mortgage, to go down. We're winning from both sides of the equation. This is one of my rentals in the Phoenix area. I bought this home in July of 2015 for $165,000. And for that, I had to put up a down payment of roughly $32,000. Fast forward 6 years, and that same house is now worth over $370,000. Now, I do need to warn you that Phoenix has had some pretty phenomenal growth these last few years, so the results aren't typical, but my measly $32,000 has turned into over $250,000 in equity. I didn't double or triple my money. I was able to 8x my money in only 6 years. And outside of that initial $32,000 down payment, I haven't had to spend any of my own money on that house, since the rent from my tenant more than covers my expenses. The mortgage on that house is right around $800 a month, but the tenant currently pays $1,895 each month. And if you thought getting a 15% rate of return from an appreciating loan was a good with a 20% down payment, what if instead you bought the house to actually live in yourself and used an FHA loan and only put in a 3.5% down payment? In that situation, you would only need $7,000 to buy that same $200,000 hypothetical scenario house that we talked about previously. And at a 3% rate of inflation, your house would gain $6,000 in value in the first year, just like we said. So you spend $7,000 in down payment to earn $6,000 worth of net worth back within the first year. I don't know what the math is on that. That's like an 80 or 90% rate of return. Now, yes, you are going to have some ongoing monthly payments, but guess what? You currently have ongoing monthly rent payments. Same thing. Except I would be willing to bet that unless you live somewhere like LA, Seattle, San Francisco, or one of the other obnoxiously expensive areas of the nation, I would be willing to bet that your monthly mortgage payment would be significantly less than what you are currently paying in rent. So if you're serious about your finances, get up, get active, and start getting serious about your credit score and saving for a down payment on a house. You generally need, like I said, 10 to 20% down payment for a rental property, or 3.5% for an FHA loan if you're planning on living in the property yourself, or you can even get that USDA loan with no down payment whatsoever if you plan on occupying a home in a slightly more rural area or the suburbs of a major metropolis city. If you found this video useful, consider subscribing, and as always, I'll see you all again next time. Thanks.